Welcome to the deep dive. If you're trying to get up to speed on the real estate tech world, maybe prepping for a meeting, or just curious how Offerpad is handling this market, well, you're in the right spot.
Yeah, definitely.
Today, we are diving deep into Offerpad's financial strategy, and we're going straight to the source. The prepared remarks from CFO Peter Nag during their Q3 2025 earnings call.
That's right. And look, we're deliberately setting aside, the broader market chat, even what the CEO said. Our goal here for you is really specific.
Surgical, almost.
Exactly. We're zooming right in on the CFO's view.
Uh,
We want to pull out the key financial health indicators, those big efficiency moves they made, and the very disciplined outlook he presented for the near future.
So just Nag's analysis, the hard number, the cost structure, the path he sees to getting profitable, it's all about that financial discipline.
Mhm.
Okay, so let's unpack it. Starting with the main financial picture for Q3 2025. What did the top line look like?
Well, the Q3 numbers, they really confirmed this trend of, let's say, deliberate contraction.
Hmm.
Shows they're focusing more on the balance sheet health rather than just sheer volume.
Right.
So Offerpad reported $133 million in revenue.
Mm-hmm.
That came from selling 367 homes in the quarter.
Okay. 133 million from 367 homes. Lower volume, which, I mean, we kind of expected given the market and their whole shift away from, high-risk iBuying. What about profit from those sales?
Gross margin was 7%. That gave them about $9.3 million in gross profit.
Hmm.
But, the metric that really shows if the internal engine is improving, that's adjusted EBITDA.
Agreed. And what did the CFO say there? Because that's the real test, isn't it? If you're cutting volume, your expenses better be dropping faster.
Yeah, so adjusted EBITDA, it actually showed a 4% sequential improvement from Q2.
Right.
So progress. But it was still a loss of $4.6 million.
Okay. An improvement, but still in the red.
Right. And Peter Nagy specifically mentioned this progress as proof that their disciplined approach and the operational improvements are, and I'm quoting here, steadily flowing through to results.
Hold on, though. If they've been scaling back so deliberately, really focusing on efficiency, why still a $4.6 million loss, even with improvement? I mean, does that maybe suggest demand just fell off faster than they could cut? Are they just, managing a decline here?
That's a really fair question. I think the CFO's story is, look, the market headwinds are intense, right? But they're actually using this low volume time strategically to completely rebuild their cost structure for when volume does return.
Okay.
So that $4.6 million loss, it reflects today's transaction reality, but the sequential improvement, it suggests they're slowing the burn rate. And they're doing it through some really massive operational changes.
Okay, let's get into those massive changes then, the efficiency side, because you said this is where it gets really interesting. The CFO seemed proud of the streamlining. What numbers show that leaner, smarter operation?
Yeah, this is really the core of it. Operating expenses, excluding their property costs, came in around $12 million for the quarter.
12 million, okay.
Now, here's the kicker comparison. That $12 million, it's a huge 37% reduction compared to the same quarter last year.
Wow, 37%. I mean, that's not just tinkering. That sounds like a fundamental overhaul of how they spend money. What does a cut like that really signal?
Well, it's basically saying the old way, the capital-heavy iBuying model that needed tons of volume and accepted high overhead, that's essentially over for them. They're retraining the whole operation to run on digital efficiency, not just carrying inventory risk.
So less like a home retailer, more like a transaction platform focused on fees and services.
Yeah.
Where did Nag say these savings actually came from? Was it one big area?
He was very clear it was across the board, like precision work in every single function. He mentioned things like optimizing marketing spend for better conversion, getting tougher on vendor terms, using more automation in the back office, and even restructuring the organization itself. The philosophy seems pretty simple. Every dollar they spend has to drive performance, margin, and scalability. And they're using data, automation, to really control those costs and outcomes better.
It sounds like technology isn't just for pricing homes anymore. It's for keeping this really tight, almost automated grip on the operating costs, more certainty.
Exactly. And Nag tied this huge cost cut directly to future profit. He said they've achieved higher marketing efficiencies, stronger vendor terms, and meaningful savings, and that all this positions them for, quote, continued EBITDA improvement in the quarters ahead.
Right.
So the idea is when market volume picks back up, this new leaner cost base should let them capture profit right away. They won't have to, rebuild the efficiency model.
Okay, so that 37% cut is like their insurance policy for future profitability. Makes sense. Now, costs are one thing, but what about the actual houses, the assets? if they're running lean, the inventory they do hold needs to perform well. How disciplined are they with the balance sheet and the homes themselves?
Yeah, the inventory strategy seems very tight, very selective. They finished Q3 holding 498 homes. The goal seems to be quick turns on properties they feel confident have good margins.
And how many new homes did they actually buy during Q3, put capital into?
Only 203 homes.
Mm-hmm.
And the CFO really stressed these were bought specifically in selective markets that met our margin thresholds.
Mm-hmm.
So basically protecting the balance sheet, avoiding riskier deals in this rate environment.
Crucial discipline there. Okay, given that reduced inventory risk, how's the overall balance sheet looking, and how are they funding this pivot you mentioned?
Well, liquidity seems decent, give them flexibility. They reported $31 million in unrestricted cash. Total liquidity was over $75 million at the end of the quarter.
Okay.
But what's really interesting is the capital strategy NAG pointed to for the future. They actually expanded their lending relationships.
No. Why do that during a contraction?
His words were to reduce cost of capital and increase flexibility. But here's the key. Specifically for scaling the asset-light businesses.
Okay. So not for buying tons of houses like before.
Exactly. They're optimizing their capital access for this different fee-based growth model.
Mm-hmm.
That $75 million in liquidity is like a safety net while they make that transition.
Yeah, that change in how they plan to use capital really underlines the shift away from traditional iBuying. Okay, so let's look forward then. What does this all mean for Q4? What's the CFO expecting?
The Q4 guidance for 2025, it's grounded in that discipline and what they can see right now. They're forecasting revenue between $100 million and $125 million.
Okay.
And that's based on selling somewhere between 300 and 350 homes.
So a slight dip sequentially in activity, probably seasonality plus their cautious stance, right?
Most likely.
And the all-important adjusted EBITDA, are those continued efficiency efforts finally getting them close to break even in Q4?
Actually, no. NAG expects adjusted EBITDA to stay roughly in line with third quarter levels, so they're guiding to a similar loss around that $4.6 million mark again.
Still guiding to a loss.
Yeah. It sounds like they're managing volume very carefully. They'd rather keep the tight expense control and flexibility than maybe push for deals just to hit a volume number.
That patience, it really does speak to how committed they are to this new cost structure. Okay, let's shift to the longer-term goal then. What's the magic number? What's the transaction level Peter Nag said gets them to consistent profit?
Right. The intermediate term target for getting to sustained profitability. He tied it to approximately 1,000 real estate transactions per quarter.
1,000 transactions a quarter, that's the threshold. But hang on, that's not just iBuying deals anymore, is it? It's a mix.
Exactly. NAG was clear on that. It includes cash offers, yes, the old model, but importantly, it also includes traditional listings they facilitate and services from their investor and other ancillary businesses. That's the evolution right there.
And that really points to the asset-light revenue streams being key. Maybe we should quickly clarify for listeners what those are. Home Pro, Renovate, Direct, plus a less. What do they actually do?
Yeah, good point. These are basically fee-based services. They let Offerpad make money without the huge risk of actually owning the house. So like Home Pro and Renovate, they manage renovations or repairs for sellers, and they collect a fee for managing that.
Got it. Project management fees.
Right. And Direct Plus 2, that often involves generating leads for traditional real estate agents, maybe collecting referral fees or platform access fees. The key is they can profit without sinking millions into buying the inventory first.
So essentially trading potentially higher but riskier inventory profits for maybe lower margin but more stable and higher volume fee income. And that 1,000 transactions a quarter is the volume needed for that new mix to work.
That's exactly it. NAG specifically said a larger share of revenue and margin will continue to come from asset-light services. It shows the leadership team sees this as the path forward, proof of disciplined execution in a more capital-efficient way.
And there was one quick note on leadership, too, that kind of reinforces this whole financial discipline focus, right?
Yes. The CFO gave a nod to Chris Carpenter coming in as the new Chief Operating Officer. NAG mentioned Carpenter's background in large-scale transformation and operational excellence perfectly complements what they're trying to do.
Yeah.
So yeah, the whole management team seems aligned on optimizing efficiency to hit that 1,000 transaction target.
Okay, that gives us a really clear financial plan straight from the CFO. So the main takeaway for you listening is that Offerpad's strategy is this sharp, probably necessary pivot towards maximum efficiency. That huge 37% EPX cut is the big proof point. They're building out these asset-light revenue streams deliberately, and that 1,000 transactions per quarter. That's the specific target they've set for achieving a more stable, diversified kind of profitability.
And that whole transition, it raises a really interesting question for the longer term. The CFO said a larger share of revenue and margin will come from these capital-light services. So how fundamentally does that change the company's capital needs, its overall risk profile, compared to the old iBuying model?
Right. Before, the big risk was holding houses,
Yeah.
right? Market swings, interest rates, renovation costs blowing up.
Yeah, but moving more to fees and services, you swap that inventory risk for execution risk. Can they manage these services efficiently at scale? It changes the skills they need, and it definitely changes the capital profile. So maybe something to think about is, what does that future disciplined, capital-efficient model really look like for Offerpad, especially if they can hit that 1,000 transaction mark while keeping that lean 37% lower operating structure?
That's a great point to ponder. Fantastic breakdown of the CFO's strategy. Thanks for diving deep into the numbers with us today. We hope this gives you the clarity and insight you're looking for.